Good morning, everyone. I'm Jillian Bender Cormier, Head of Culture and Engagement at Bender Insurance Solutions. We're thrilled to have you join us for another insightful session of our Bender U webinar series. Today, we focus on a crucial topic for your business's success: protect the future of your business and drive growth through trade credit insurance. Before we get started, here are a few housekeeping points. If you have questions during the webinar, please type them into the Q&A section. We'll address as many as possible during our dedicated Q&A session at the end. If we run out of time, however, don't worry, we'll follow up with you individually after the event. For the best experience, you're all in listen-only mode and will remain muted throughout the session. We are recording today's webinar. After the session, you'll receive a link to the recording and a copy of the slide deck for your reference. We're excited to learn from an exceptional panel of experts today. To introduce them, I'll hand it over to our VP of Alternative Risk Markets, Roland Gillen. Welcome, Roland.
Thank you, Jillian, and good morning, everybody. It's my pleasure to introduce Dan North. Dan is the senior economist for Allianz Trade North America. Dan has been with Allianz Trade since 1996, using macroeconomics analysis to help manage their amazing portfolio of $1.5 billion in U.S. trade transactions. Dan has appeared on CNBC, Fox Business News, and Bloomberg Radio. Joining Dan is Ryan Winkler. Ryan is a dedicated risk management consultant with Allianz Trade, the Pacific Northwest region. Ryan has partnering with Bender Insurance Solution. He manages a diverse portfolio of industries, including manufacturing, and has helped businesses mitigate risk and achieve their financial objectives. Welcome, Dan, and welcome, Ryan.
Thanks, Roland, and thanks, Jillian. Certainly appreciate it. And thanks to everybody that tuned in this morning. I'm going to speak for about 20 minutes on the U.S. economy, and then I'm going to hand it off to my colleague, Ryan. Ryan's going to tell you a little bit about who we are and what we do, but I am too. I'm going to show you just a little bit so you get an idea of where our analysis is coming from. So let's talk about inflation. We'll go to the next page. And the page after that, we'll look at a couple of measures of inflation. And as I say across the top, inflation still has a way to go, so the Fed is in no hurry. And the most common measure of inflation is over on the left. That's the Consumer Price Index. The blue columns are the month-to-month changes. And you can see it's kind of volatile, up and down and up and down. And as a result, the black line, which is the year-over-year rate, has been going sideways for 13 months, going nowhere. Now, it did take a little bit of a hitch down to 2.4%, but it's important to think that it has gone sideways for 13 months. There's nothing that really indicates it can't go back up. Now, that black line, year over year, you see all the way on the left, reached a record of 9%. And then it went down to 8 and 7.5 and 6 and so forth. Those are really high inflation rates. And the point of that is that inflation is cumulative. So let's say you bought a loaf of bread for $1 on the 1st of January 2021. Inflation's 10%. The next day it's $1.10. The next day it's $1.21. The next day it's $1.33, if I get my math right. Inflation accumulates over time. That's the chart on the right. If we go back to January of 2021, when inflation really started to pick up, cumulatively, the black line, wages have risen 17%. But everything that wage earners need to live, such as food, have been up 22%, shelter 23%, gasoline 35%, and so on. And that's why I say the text on top of the box, this is why inflation prices still seem so high? It's because they still are. We still have inflation, and it's built up over time. And this is probably why many Americans think the economy, even though there's growth, everybody has a job and so forth, the economy is bad because they're still underwater on a cumulative basis. If we go to the next page, we'll look at another couple of measures. Over on the left is the Producer Price Index. This is a measure of prices that producers of goods are getting paid for their goods and services. Reached a record of 11.7%, very, very high, but now has come down, and in June of 2023, it reached 0.3%, 0.3%. But ever since then, it's gone the wrong way and is now 1.8%. So it just emphasizes that inflation hasn't been completely snuffed out yet. Finally, let's go over to the right and see, now let's go back to, yes, and see another measure of inflation. This is the Fed's favorite measure of inflation, the yellow line. It's called the PCE Core Inflation Index. You can see it peaked at 5.6% and now has come down to 2.7%. And as a result, in an effort to cure this inflation, the Federal Reserve rose the Fed funds interest rate, that black line, to fight off inflation, and it worked. The yellow line came down from 5.6% to 2.7%. However, 2.7% is not 2%. That's the target. And it's 2% doesn't just mean touching 2%. It means getting to 2% and staying there or less for the foreseeable future. So I think we're a little way from getting there yet. And you can see there on the right of that yellow line, it went back the wrong way last month. So we're not quite there yet. By the way, that black line is the line, the Fed funds rate that the Fed uses to influence the economy. A lot of people say, oh, the Fed's raising or cutting interest rates. And I do too, because it's convenient. But really, the Fed only controls that one interest rate, that overnight Fed funds rate. All right, so I make the argument that I'm not really sure that we really killed inflation. So if we go to the next page, we might ask the question, if inflation's still here, why is the Fed cutting? Well, it's because the economy is cooling. And I'll show you on the next page some examples of where we're seeing the economy cooling. In particular here, the labor market. It's been strong, but is now fading. So the box on the left is jobs created every month. And job creation had been pretty strong, but is now slowing quickly. That's the blue line. You can see it slope down very sharply recently. Now, the black horizontal line is the pre-COVID average, the 5 years before COVID, and that's 193,000. So you can see where we are today is right around the same level. The point of the chart is job creation is coming down rapidly and now is no better than it was on average. Here are two measures, other measures in the middle. Blue line is job openings, down 14% year over year. So job openings are down sharply. And it's actually probably worse than that because a lot of companies post what they call ghost jobs. That is, they post a job that maybe they really never meant to fill, or they've just left it there available to fill if somebody comes along that's great. So their job openings have probably fallen even more than that. The black line, job quits, this is when somebody feels like they've really easy to get a new job. And you can see there was a big dip right after COVID and a big spike up after COVID because people thought, oh, labor is really tight. I can get a job whenever I want. It was the Great Resignation. Well, you can see quits, the black line, now has come down sharply, 14% year over year. That Great Resignation is no longer so great. And in fact, that horizontal dotted line shows we're now back to pre-COVID levels on quits, well below the pre-COVID levels. And then finally, the chart on the right shows unemployment claims, and this goes back a couple of years. And you can see that they have been on a rise as well. It's volatile, but they're certainly rising. So those are four measures in the labor market that show a slowing, cooling economy. And on the next page, we'll see what's happening in manufacturing. It's in decline. That chart on the left is the ISM Manufacturing Index. It's called the Institute of Supply Management. It's a survey that's been around since the end of World War II. It's a survey of supply managers who are really on the front line of their businesses. And the way you read the survey is if it's below 50, you're in contraction. So the black line is the overall index at 47.2%. That is in contractionary territory. Perhaps more importantly, the blue line, new orders at 44.6%, that's well into contractionary territory. New orders, that gives you an idea of what's in the pipeline, what's going to provide employment and economic activity coming in the future. Similarly, over on the right, across the top there of the chart, these are new orders for durable goods. Durable goods meaning big ticket items such as home appliances, refrigerators, dishwashers, clothes washers, so forth, going up to train locomotives, cars, planes, that sort of stuff. Durable goods, big ticket items. That's blue line is the year-over-year change in durable goods orders, in new orders, again showing us what's in the pipeline. And you can see historically, this chart now goes back 30 years. When that blue line, that year-over-year change goes negative, it's often associated with a recession. That's those gray columns there. We don't have a whole lot of data to show different recessions, but when it does go negative, it's associated with a recession. And right now, we can see that the blue line is at 0% growth. So these measures show, I believe, that manufacturing is in decline as well. So I've seen labor in decline and manufacturing in decline. Let's look at the next page, which shows us the most important part of the economy, consumers, 70% of the economy, and they're slowing their discretionary spending. Now that's the chart there on the left. That's retail sales year over year. Year over year, excuse me, it says 2.2%. Well, an update came out this morning. It's now actually 1.7%, so it's going down even more than in this chart. And it's well below that average there of 4.3%. Now, if you look at the text right above the box, it says retail sales are slowing because consumers need two things to spend: the willingness and the ability. And going over to the right, you see the text saying, at the moment, the willingness is okay, but declining. The willingness there is that blue line, a measure of consumer confidence, now at 98.7 versus the long-term average of 96. So it's an okay level, but certainly decaying. So the consumer's, let's say, walking away from this, the consumer is more or less willing, but is it able? Let's go to the next page and we'll see if consumers are able to spend. Well, that's the chart on the left, real disposable personal income. That's after inflation and after taxes. And you can see the black line, the year-over-year rate, peaked at 5.3%, now down to 3.1%, which isn't bad, but you can see the trend is clearly down. And over the past few months, the columns has been pretty weak. Another source of money for spending is the chart on the right, excess savings. This is from the fiscal programs we had after we shut down the national economy for COVID. This was the CARES Act and the CAA and the American Rescue Plan and so forth, put $2.3 trillion of savings in consumers' pockets, which really helps support spending. You can see now that's down to 0.4%. Okay, so you've got all right willingness to spend, but your ability to spend, which is income, is starting to slow, and that excess savings is starting to waste away. Well, now where do you go to spend? Well, we can look at the next page and we can see that we go to credit cards. That's the chart on the left. This is the cumulative growth in credit card debt, which is the black line, cumulative since January of 21. Credit card debt has grown 44%, spending 24%, and income 13%. So you can see that credit card debt is clearly outstripping those major variables and supporting the consumer. And this has happened before, and then consumers sometimes pay down the balance sheet, and it's maybe not out of hand yet. But the problem this time is the chart in the middle. These are the interest rates that consumers are paying. They're at an outrageous record high of 21.5%. And if you have a lower credit score, then it's getting up towards 30%. So as a result, you have lots of credit card debt outstanding at very high rates. And as a result, you get the chart on the right, which is a rapid increase in delinquencies. Delinquencies have doubled in less than 3 years. They're now at the highest in 12 years as well. Okay, so we see that the labor market and manufacturing and consumers all are getting weaker. And as I said, the Fed has started to cut rates. And if we look at the next page, the question arises, okay, how long is it going to take for these rate cuts to help? Well, if we look at the next page, we can see that the chart on the left shows that black line, that Fed funds rate, and this is going back 40 years now, and the blue line is the 30-year mortgage. And if you go all the way to the left in that red circle, you can see where the black line is going down. That means the Federal Reserve started a rate cutting cycle. And if you look at the blue line, the mortgage, well, it probably came down less than half the Fed funds rate and not as fast. If you look at the next one, you can see a pretty big drop in the Fed funds rate. The mortgage rate hardly moved at all. Same thing in the next circle and same thing in the fourth circle there. The point of the chart is when the Fed cuts the Fed funds rate, the mortgage rate does not follow down as fast or as far. So you wouldn't expect to see relief in the mortgage market or housing anytime soon. Similarly, the chart in the middle is manufacturing. Now it's the same black line. It's the same Fed funds rate. Now it's going back 50 years. The blue line is a measure of manufacturing. It's manufacturing where there's red text. The red vertical dotted lines are when the Federal Reserve starts a cutting cycle. So if you look at where those red dotted lines intersect the black line, you can see that's where the Fed starts to cut. Again, coming back to the text there at the bottom, you can see in red, I say rate cuts start here, but It takes months for manufacturing to start recovering. There's always a lag in monetary policy. It's 3 to 5 quarters. So you wouldn't expect big relief there in the housing market or manufacturing. And finally, on the right, we have less data on credit cards. This is going back 30 years, same black line, the Fed funds rate. Yellow line is the credit card rate. Hardly moves at all when the Fed cuts rates. And I don't think that yellow credit card rate is going to come down very rapidly this time either. Now, let's go to the next page, which talks about the election. Most people are focused on the presidential election. Let's go to the next slide, which of course is important. And this chart will certainly give out a PDF of this chart because there are many points there. The most important economic part that is most likely to affect the economy is in red there in Donald Trump's lines. He's basically wants to impose a 10% tariff across the board on everything, and 30 to 60% on imports from China, and so forth. These tariffs would be really damaging to both our economy and the global economy. So that's something to watch carefully. And if we go to the next page, I'll mention that the congressional elections are actually critical as well. So the left-hand boxes is the Senate, and the blue line shows the probability of the Republicans winning, which is about 60%. But if you look at the box below that, you can see the blue line, it's the Republicans winning 51 seats, the Democrats 49 seats. So it would take only one by this model, only one seat to potentially flip the Senate. Same thing over on the right. The House is 220 to 215. That's a 3-seat race effectively as well. But let's think, make the assumption that both of these charts are right. In the text at the right, you can read that if you believe these polls from this race to the White House, no matter who wins the presidency, they will face a divided government. And that's often thought to be good because it allows Washington to do what it does best, which is nothing. It keeps any one party from taking control of legislation. It gums up the works, so not much happens except for spending money. So it provides certainty and status quo. Okay, on the next page, I'll wrap up here. We see weak but stable growth for the rest of this year and into 2025, but not a recession. Inflation's not dead, but we do expect to see the Fed continue to cut well into 2025, driven by a cooling inflation and a lukewarm economy, and still keep an eye on those congressional elections. Okay, that's our view of the U.S. economy, and at this point, we'll move over to my colleague, Ryan Winkler.
Thank you, Dan. I appreciate passing it over. I think his presentation on the economy lends itself very well into talking about trade credit insurance. Before I start talking about trade credit insurance and accounts receivable, I kind of just want to throw out some terms to make sure we're all on the same page as I go through this presentation. So to start, we're going to be looking at strictly B2B or business to business transactions. And within those transactions, the supplier offering open credit terms to their customer. Open credit terms meaning they're giving them net 30, 60, 90, whatever that amount of time is, days to pay them back for that invoice. That is what I'm referring to with open credit terms. And essentially with open credit terms between one business and another, it's really a unsecured, no interest, no collateral really in place loan for 30, 60, or 90 days to the other business. And that's where trade credit really comes into play. So moving on to the first slide, trade credit insurance, in the way I view it, is really a two-sided solution for a business. On the surface, or in this graphic on the bottom, is the insurance piece of this. It is the coverage against your accounts receivable from non-payment or slow payment from your customers. So that is the insurance piece of it. However, which we'll go through on this presentation, is by us underwriting and evaluating the financial health of your customers and providing that insurance, in turn, it's given us the largest database of financial information on businesses worldwide. And that allows businesses to leverage the information we have to have the knowledge to discover who their really strong customers are that they can sell more to, as well as avoid selling to the customers that are a lot riskier. So it's really a two-sided solution. It's not just insurance, which we'll dive through today, but it's also a tool that serves as a buffer between your business and your customer. So moving on to the next slide, I think this graphic really just shows you how much information is truly in our database. We often say we're an information company first and an insurance company second. You'll see we track over 92% of the global GDP. We have over 80 million companies in our database that we're monitoring the financial health of. We're processing over 20,000 credit requests a day. So essentially, you're hiring the world's largest credit team. You're getting access to all of this information that we hold in our database, and that allows you to do a couple things. So moving on to the next slide is really kind of the four buckets people fall into on why they use trade credit insurance. We call them the four pillars, but the first part is the insurance piece of this, the protection against taking a catastrophic loss or even smaller losses that disrupt the cash flow of your business. But the next few pieces are more on that information side. And you may ask, how do you use an insurance product to expand your sales? I'll talk about that in a later slide, but briefly, with our information in the insurance guarantee on the back end, clients are able to be more aggressive in the credit terms they're offering their clients, because they're either going to get paid by their customer or they're going to be paid by us. So it can really be a tool to push growth on the credit side as much as it is protection on the back end. The last two pieces are really streamlining your credit process. Most clients I meet with range from not having a solid credit approval and process in place versus having a very sophisticated process. However, trade credit insurance provides a true structure to your credit process that also is backed by that financial guarantee. And then lastly, there's some specific scenarios when using your accounts receivable as collateral with an asset-based loan that we'll talk about briefly. But those are kind of the four main reasons people partner with us and use trade credit insurance. So jumping into the next slide, there's some misconceptions out there about trade credit insurance, about accounts receivable insurance, that it's strictly for when companies go bankrupt. However, as we'll see some statistics later in the presentation, a large majority of our claims come from the slow payment side of things, or what we would call protracted default situations. I'm sure plenty of you are familiar with. They're not responding to your emails anymore. They're not picking up the phone, but they haven't filed bankruptcy. That also qualifies as a claim under trade credit insurance, not just bankruptcy. So that's a misconception that some people have, that it's only for bankruptcies, but you'll see later a large majority of claims come from the slow payment side of things. And then lastly, if you're exporting and selling internationally, there's coverage there as well for things, let's say like a trade embargo that happens and your product gets stuck out there. That also qualifies under the policy. Moving to the next slide, I think this slide is really just a frame of mind change when you're looking at the value of the assets of your business. We talk about in the insurance world a lot risk management and making sure your assets are secure. And most businesses that we meet with have, if not more, 40% of the value of their business falls under accounts receivable. However, they'll have insurance on their land and buildings, their machinery and equipment, but they'll leave their largest asset uninsured. So I think it's really just a frame of mind when you look at your accounts receivable. It's really kind of like the blood flow of your business, money coming in and money going out. And trade credit insurance is a tool to not only insure your accounts receivable, but really manage the risk of all your customers, how much you're selling to each customer, new customers and existing. And it's really just kind of a frame of mind as we're looking at your overall business and how much your accounts receivable portfolio makes up of the entirety of your business. This next slide is the last slide on the true insurance piece of this before we start moving into some of those other areas where you can leverage our information. I'm not the best at math, so a simple example here is this chart that describes how much revenue it takes to recoup a loss. Most business owners and CFOs that I meet with, I hear this response often, that taking a few losses, whether it's 25, 50,000, whatever that dollar amount is, that it's just sort of the cost of doing business. Hey, we take 25, 50K a year. It's really not that much. It's just sort of the cost of doing business. I hear that often, and I can understand that sentiment. However, if you really dig into the numbers, on a conservative side, if a $50,000 loss happened, you average a 10% profit margin. It takes $500,000 or $500,000 to make up for that $50,000 loss. So while that $50,000 loss may not have been a huge amount, it takes a heck of a lot more revenue to recoup that loss. And what I would ask is, where would you go and find that additional revenue? Are you going to extend more credit to new customers and take some additional risk there? Are you going to try to sell more to some existing clients? Or are you simply going to absorb that loss? So I think this is just kind of another frame of mind when we're looking at taking a few losses. That doesn't have to be the case, and trade credit insurance can help you mitigate the risk of taking some of these losses no matter where they fall on this chart. So moving on to the next slide, you'll see this is really the main goal of what I try to help my clients with when we're evaluating their business and trade credit insurance. This is really the main point that I'm trying to get across, is if we can help you find a handful of customers that you would otherwise restrict credit to versus offering the full amount they're requesting, if we can find a few of those a year, the policy really becomes, if not a net neutral cost, a return on investment to this solution. So running through the numbers quickly, let's say a new customer comes to you, they request $100,000 of credit to pay you back in 30 or 60 days. You're not too comfortable extending them that full amount. There's not a whole lot of information out there. You don't have any history with them. You say, we'll start you off at 50,000 and we'll reapproach this in 6 or 12 months once we have that history to potentially extend you the higher amount. However, if you had a trade credit insurance policy in place, you punch that new customer into our portal, we approve the $100,000 amount. Now you're able to not leave that money on the table. It creates an additional $50,000 of sales with that one customer. Once again, easy math. If you have a gross profit of 10%, you turn that accounts receivable. All that means is how many times you're selling through your accounts receivable or to this customer. So let's say 10 times it averages out to across the year. That comes as $500,000 of increased revenue, $50,000 of gross profit, and that's just one customer in this example. So that's my main goal here, is if I can help your business find a few customers you're restricting, and we can help you sell more to them with the information we have and the insurance guarantee on the back end, then the policy cost really becomes a net neutral. So that's my main goal here, and that's how you use this insurance product to expand sales. So moving on to the next slide. This is our risk grade scale. We make it super simple to understand, 1 through 10. 1 is the best, let's say like Costco. 10 is the worst, is a business that recently filed bankruptcy, let's say like Big Lots. All this number represents is the probability that your customer is going to be able to fulfill their obligations to their supplier or you as their business. And we are not looking in the rear view mirror. This number is looking in the future. This is the probability moving forward that your customer is going to be able to pay you back. And while this scale is super simple, there's a lot that goes into this risk grade scale behind the scenes. So there's public information, whether that's them being a public company, industry reports, every mercantile report that's out there available to the public. We're compiling all that data. Then there's all the proprietary data that we have. So we're talking about all the trade history that we have, confidential financial information that we have. We're a part of things like the SBFE, which is the Small Business Financial Exchange. That gives us insights into businesses, how much they're using their credit cards or their credit line with their bank to see how much they're borrowing. And we compile all those data points into a simple risk grade scale so it's easy to absorb. Moving on to the next slide, I think this is really the key piece of trade credit insurance. It's really an investment in modernizing and scaling your current credit process. One of the key points here is we are not only looking at your customer when you enter them into our system, but once they are in our system, we are actively monitoring all of those customers. So as we know, things are crazy right now and all over the place, and things change quickly. So we are not just looking at them today. We are going to notify you if things change and they're financially deteriorating. Or on the flip side, we're also going to tell you if they've improved and you should sell more to this customer. The level of information in our database still surprises me sometimes to this day. With a recent new client I met with, evaluating their accounts receivable, we looked at a list of their main customers, and we had confidential financial information on close to 80% of their customers. Now, that's not always the case. However, being able to tell a client, hey, we have confidential financials on 75, 80% of your customers, those are insights that most businesses do not have on their customers. So it still even surprises me to this day, the level of information we have in our database. Last two pieces kind of go together, but it's a true structure and investment in your credit process, as I mentioned. But the big difference is no matter what the process is that you have in place with your current business, if you're pulling mercantile reports, you're calling trade references, you're asking your friends in the industry, whatever the case may be, you lay out all the information on the table. There still has to be a decision that's made with the information that's been gathered. Are we going to extend the amount of credit they're requesting? Are we going to restrict the credit? We have to make a decision on what to do with all this information, versus with a trade credit program, you're going to get fast decisions with extremely strong data that's going to tell you the amount of credit you should be or can extend to this potential client. So moving on to the next slide, I think is just a nice example of the difference of the credit process of today versus what could be with our trade credit program. So the typical process in most businesses that I meet with is the sales department comes in with a new customer. They ask for a new credit limit request with the credit team. As I said, they pull whatever reports they pull. That turnaround time can be anywhere from a few days. I've even heard up to two to 3 weeks at time to approve credit for specific customers. And as I mentioned before, that credit manager or controller or CFO, whoever is making that decision, has to lay out all that data and still kind of take a leap of faith on, is this customer going to pay us back for what they owe? Or are we restricting the credit we give them and potentially leaving some sales dollars on the table. Versus with our program, your sales department can come to you with this new customer. You punch it into our online portal, you get an answer within 24 hours on domestic customers, if not quicker, and you get a true decision based on accurate information that is also backed up by our insurance guarantee. So on these last few slides, moving into the next one, this is just a quick point on specific scenarios where a business is potentially looking to get access to more working capital. If you have or are interested in an asset-based loan with your business using your accounts receivable as collateral, most oftentimes we see some restrictions. The most common ones being if you're selling internationally, those are almost always going to be excluded. If you have some high concentrations with key accounts, those can either be excluded or limited, as well as if your lender feels just the overall risk profile of your accounts receivable is just a little more risky, they may limit it there as well. So quickly going through this example, this business does 20 million domestically, 5 million internationally. Their current asset-based loan gives them a 75% advance rate on their domestic sales, what's on their AR agent report, gives them access to $1.25 million, but their internationals are completely excluded. Putting a trade credit insurance policy in place, turning your accounts receivable from really a promise into a guaranteed secured asset, you're going to get more favorable terms with your lender or bank. And this is just an example, bumping up the advance rate from 75 to 85%, being able to include a majority, if not all of your international business, giving you access in this example to close to $500,000 of additional working capital for a policy that cost nowhere near that. So this is just an example, but using trade credit insurance to better leverage your accounts receivable portfolio will most definitely be able to help you get more working capital in specific scenarios. So moving on to the next slide is really kind of the last piece of information I just want to leave you with is it does not hurt to take a look at your accounts receivable portfolio and at least compare the information that you have versus what we have. You'll see recent examples from very large businesses like Bed Bath & Beyond, 99-cent store with billions of dollars that was owed to their suppliers filing bankruptcy. You'll see some statistics on the left about claims and past due claims. Those numbers have continued to rise. We don't have the full 2024 calendar year numbers, obviously, but those numbers have continued to rise as well. We're now comparing bankruptcies and claim payments out to 2008, 2009 numbers. And I just want to reference back to earlier in the presentation, over 90% of claims were due to slow payments, not bankruptcy. Over 96% of the claims were domestic. It's not just for international sales. It can be used here domestically on your customers, and it's not just for bankruptcies. So I'd leave you with all I offer is it doesn't hurt to get a risk analysis from myself and Roland at Bender Insurance. You never know what information we may have on your customers that could open your eyes as to what's kind of going on behind the scenes. So with that being said, we'll move to a Q&A session if you have some questions that you have about the economy or for myself with trade credit insurance.
Wonderful. Thank you so much, Ryan. We are going to go ahead and open this up to for Q&A. And it looks like we have one that's come through. I've worked with my customers for years. I have great relationships with them. They've always paid me on time. What's the reason to insure them?
Sure, I think that's probably the number one response we get from most business owners that we meet with is they have great relationships with their customers that they've worked with for years, and they've always paid them on time. The two things I would say is just because they've always paid you on time doesn't mean going forward they're going to be able to. But two, when I hear a business owner or a CFO or a controller say they don't take any bad debt losses, their customers always pay them, my first thought goes back to that sales expansion slide. That money's being left on the table somewhere, and you're being conservative with the credit limits you're extending. And those customers are willing to buy more, but you're not willing to extend the credit limits to them. So by using a trade credit program, you can sell more to those customers that are requesting more. And on the flip side, we're an unbiased third party that isn't looking at the relationship you potentially have, but we're looking at the financial data that we have to make sure they're going to continue to pay you moving forward.
Wonderful. Thank you so much, Ryan. Based on your economic outlook, how will the stock market react? Is a question that's come through.
Well, I don't know. And anybody that tells you they know doesn't really know either. They're kind of fooling themselves. And I can say that because I worked in investment research for a period of time. And I learned several things. One is, most importantly, you cannot time the market. And what I mean is, and I've seen this study twice. So if we look at a 20-year period of the S&P 500, it turns out that the largest returns come on just a handful of days. So if you miss the best 10 days over 20 years, your return gets cut in half. And that's because the compounding of the big, big days. So if you think you can, be out of the market on the good day, on the bad days, you're probably going to lose, because what's going to happen is you're going to fall victim to the classic retail investor way of thinking, and you're going to end up selling at the bottom and buying at the top. So you can't time the market. You can't tell when there's going to be a dip, a big dip, or a big jump. And the second thing is you can't pick stocks. Even the professional mutual fund money managers have all kinds of sophisticated tools and people that work for them, and on average, less than half of them beat their benchmarks. Less than half. Now, sure, somebody might beat their benchmarks for a couple of years, but over the long term, no, they're going to miss their benchmarks. So to try and say, what's going to happen over the next month or year or so, it's my guess is as good as anybody's else. I will say that over the long term, the stock market has proven to be the strongest investment, and that would be my expectation going forward.
Wonderful. Thank you, Dan. Another question. I don't take any bad debt losses. Why would I need trade credit insurance?
Sure. I think that lends back to my previous point on if I meet with a business owner and they tell me they haven't taken any losses in an extended period of time, the 2 points are that doesn't mean in the future you won't, but two, more times than not, if you're selling business to business on open credit terms and you haven't taken any losses at all, I'd be confident that there's situations where you're limiting the credit limits that your customers potentially want with you, and you're being conservative on the front end, which I can understand, as nobody wants to take losses. But if there's a tool out there, for example, like a trade credit insurance program that can allow you to sell more to these customers, then you're leaving that money on the table and you can expand your business into new markets, new customers, internationally, whatever it may be. Um, I've never met with a business that extends all the credit that their customers request and have never taken a loss. It's usually one or the other. Either they're extending a lot of credit and taking some losses, or they're being conservative on the front end and missing out on some sales opportunities. So I would say it takes a deeper dive into your current process to see if there's being customers that are either being limited or not sold to as much as possible. So that's where my mind goes on not taking any bad debt losses.
Thanks, Ryan. We have time for one more question. And again, if we didn't get to answer all of your questions, we can gladly reach out to you after the webinar has concluded. But I think this one's directed towards you, Dan. How do you feel about AI?
Well, it's a very controversial topic, but and one of the big reasons is AI has thought that it's going to take over a lot of jobs. And every new major technology has had that same argument against it. The very first one being the Luddites, who handmade socks until somebody came along with a loom that could make socks much, much faster. And the Luddites hated that, and they busted up the looms because they're going to put them out of work. Well, the looms made socks so much faster, they made socks so much cheaper that the demand for socks skyrocketed, and so the demand for jobs for people that made socks. So new technologies do destroy some jobs, but they create more. So let's think about auto robots, auto robots. A union member will come out and say, hey, look at this robot. I lost my job because of the robot. And a congressman will have him on the steps of the Capitol and say, this poor guy lost his job because of all this automation. Well, it may well be true that guy lost his job because of automation. And that's when you see it, the guy in front of the Capitol. And that's when you see it in articles in Business Week and that sort of thing. You never see the jobs that are created by the new technology. And on net, it's usually many, many more. That's what I expect to see here with AI, a tremendous increase in productivity. And just go back to the example of the robot. Yeah, it replaced that one guy's job, but now somebody has to design the robot, somebody has to build the robot, somebody has to install it, somebody has to maintain it. So you've created jobs. And I think that's what's going to happen with AI as well.
Wonderful. Well, thank you both for your time today. Up next for Bender U, the 2025 Labor Law Update. That's one of our most popular classes. It's Thursday, November 7th from 9:30 to 10:30 Pacific Standard Time. If you scan this QR code here with your phones, you should be able to go ahead and register for that. But I just want to take a moment and just thank Dan and Ryan with Allianz for sharing with us today. We appreciate you all for taking time out of your busy schedules to join us for today's Vendor U. As a reminder, while the session has been recorded, and both the recording link and a copy of today's slide deck will be emailed to you following the webinar. Should you have any questions that arise later on, please feel free to reach out to us. We'll be happy to help. But thank you again, and we hope you all have a wonderful day. Thank you, Dan. Thank you, Ryan.
Thank you. Bye-bye.
Thank you, everybody.